Accounting information systems is a conceptual framework. Essentially, what it is like not like necessarily how it's gonna be built, but like the different parts of it conceptually. So like the reason behind the framework itself is that you could theoretically build this. Well, I wouldn't say like build it, but like you could pretty much have this system be just a bunch of pieces of paper and people. But utilizing technology, especially information technology, there's like this information system, which is like coded. It's built using like computer language. Essentially, what it is like utilizing like computers to build this system that automates a lot of this process, so people don't have to do the work. Um, and like the whole point of it is to amplify this process in regards to like the flow of information, in regards to the operation personnel, operations management, the middle management, top management, the day-to-day operations, the performance, and the budget information, etc. So like there's like a lot of stuff in this. I'm just gonna like go through this real quick to just get the gist of it, and then we'll go back and like we'll break it down. Essentially, like and the role of the accountant within the system itself, like as a stakeholder or as like a domain expert, like this a system is actually built to help accountants do like the roles and responsibilities that they have to do anyways, as well as like this auditors that do like audits within the internal system. But pretty much you'll pretty much have like three main things, like the general ledger, financial reporting system, TPS, the transaction process system, the management reporting system, and like the cycles within the transaction cycle, the transaction processing system, like the expenditure cycle, the conversion cycle, the revenue cycle. This is like really the main gist of the process. Like the transaction processing system is like one of the most important parts about the AIS. For example, like TPS would send like reports to the general ledger. Not reports, but like it would send transactions. It would send like data to the general ledger, and then the general ledger, whether it's real time or batch, it would get like updated based off of like the transactions that are happening within the TPS. And like TPS, pretty much what it is like the whole cost processing, like the whole cost accounting system. Like when it comes to like revenue, like when these finished goods are sold to the customer, the expenditure, like the cost, the things that it's going to take to like build this good, and like the purchasing related to that as well, payroll, cash distributions, and then like the conversion cycle. So like the AIS really like encompasses like the whole company in regards to like almost everything they do in regards to like the finances of the company. So to speak, not necessarily like it wouldn't necessarily like be like for like stock, for example. It wouldn't be like focusing on like the sales of the stock. It wouldn't really record transactions in regards to that unless like the company is more of like a stock company. You know, like sometimes the AIS might be a little different based off of like what it is they're exactly doing. A lot of times they're gonna have materials. They're gonna, unless like it's a service based industry, so like most of their costs in regards to labor, in regards to payroll. So like there won't be as much conversion in regards to like the finished goods, so to speak. But they're still gonna have a revenue cycle. So like the AIS, regardless of like, they could figure it out. They could like adjust the AIS based off of like whatever it is. Like if this company is like a money service company, like they don't actually have a product. What they do is like they provide like money handling or money services. Then like they wouldn't necessarily have finished goods or like they wouldn't have material costs. But like that doesn't mean they still can't utilize it in AIS. So like there's a lot of stuff in here, like a lot of stuff to know, like, um, but like the gist of it, the most important parts are like the cycles, like in regards to the revenue cycle, the expenditure cycle, conversion cycle, and like sort of like this thing called like the conceptual as the physical parts of that cycle. So like it's saying like, oh, conceptually you have to do this, but like physically these things happen. As well as like the risks in regards to the cycles. Like, so one of the conceptual ideas about revenue is like they're gonna have to receive this order, right? They're gonna have to check the credit of the customer. They're gonna pick the goods. They're gonna ship the goods. All these little things that they're gonna have to do conceptually. But like at the end of the day, physically, this is the things that they'll actually do, right? Like as in like physically, they might have a mailroom that would receive envelopes in regards to like the checks, or they might have a computer system. So like conceptually, what it means is like physically they would have to work on the computer to accept like digital transactions, pretty much. But like if they have a mailroom, it's a lot more easier to understand. It's like, oh, this is like a physical mailroom where they receive like these envelopes and stuff like that. Uh, and then like there's like access control, physical controls. Not like physical controls, like access controls in regards to like the security of the physical building per se, but rather like the physical controls in regards to like the separation of duties of like people working within like these physical like cubicles or like supervision or like these records or like the doc like where are these records stored, for example. But these are like physical controls that would help ensure like these the whole point of like controls, like internal controls, the whole point of control is to ensure like that there aren't going to be things that happen that or would be like disastrous, so to speak. Like there's a lot of risks in regards to like, for example, like some of the risks could be like selling to uncredit worthy customers, right? So that could increase bad debt expense. So like one of the things, because of that risk, like one of the things they can do to mitigate that risk is to um, do more credit checks on the customers. But like the risk of it is there regardless. But like there's various different risks along the entire process. But then like the TPS in particular, like within these cycles, like the expenditure cycle, conceptually they have like these things like in regards to like the expenditure, like they're gonna have to purchase, processing procedures, they're gonna monitor inventory levels, receive goods, set up AP, and they're gonna have like voucher payables. Um, and then physically they might have inventory control. Right, they're gonna have like inventory control in regards to like the physical inventory itself, if there is in fact physical inventory. They're gonna have receiving, but not necessarily like warehouse receiving, but like they would have like apparently like physical part of it would be like a packing slip, for example, in regards to like receiving certain types of materials, for example, for their processing, for their manufacturing process. They have like all these different things. Like, is this stuff is really in depth. of the distribution system, the distribution system cache. Internal controls is like a really big thing to talk about. Like there's gonna be like risks on every single part of the expenditure cycle, um, and it could not even be like related to like when it says risk, it's not necessarily like malicious risk or like bad actors, but rather like there are certain things like that happen. But for example, there could be unauthorized inventory purchases. That is a risk of the expenditure cycle. Uh, yeah, risk of unauthorized access. So like when you guys, you know what? I'm gonna make another video to talk a little bit about controls.